Is anybody following the Camber Energy short squeeze? I just did a video on them. I've never seen so many shares traded. They traded 500 million shares each day for the past 10 days. That's just ridiculous. Let's see what that is. 500 million. $553 million. And they're trading at 325. Their market cap is $338 million. You holding? Yeah, I think it's going to go up. I mean, it's going to crash. I'm just not sure when. Hey, Ben. So 533.5 million shares are traded each day on this stock for the past 10 days, which is $1.7 billion of trading activity for this one stock, because the stock is trading at 3.25. And the market cap is 338 million. So it's trading at 5 times its market cap each day, which is, some stocks, so every share is getting traded 5 times. That's a lot of movement. Some stocks could take a year for all the shares to move. Every day, 5 times the number of shares are moved. So that means nobody keeps the share. They just keep shuffling around. I guess that's what you do with these. But it just looks like an awful company. It just looks terrible. This is where the stock has been trading. It was trading at $170 million a share in 2007 because of all the reverse stock splits. It's done 3 1-for-25 reverse stock splits and a 1-for-50 reverse stock split. So every time it does that, it makes it look like the early numbers look really high. And the company hasn't reported any financial information since September 2020. So it didn't report the year-end numbers in 2020, the first quarter of 2021, or the second quarter of 2021. They just didn't provide any information, which is not allowed. That's when you're a public company, you have to provide information to the public. But they're saying that they can't. It's taken them longer. because they acquired Viking Energy, and it's taken them a lot longer to put the financials together. But the way it works is, if you own more than 50% of a company, like they own, I think 100% now. They did own like 60% a few months ago. I think they bought more of Viking. You just have to consolidate the numbers with your numbers. So I mentioned that in the video, but I know the dates don't match, but what's it called? So this is Camber, this is Viking. So Camber had 400,000 of revenue in 2020, and Viking had 40 million. So all Camber has to do is just add that 40 million to their numbers. So all their numbers, all Viking's financials get consolidated onto Camber's numbers. I'm sure there's more involved than that, but I mean, this happens all the time. I don't know why they can't put that together and just give us the information. So that's why about 25% of the shares, almost 24% of the shares are shorted. And that's going to probably go up a lot more because the stock is climbing. It was only like 50 cents a month ago, and then it got to over $5 at one point. Now it's $3.25. But the real winner, not that you could have known this, but if you invested in Viking, because they were real low. I think they were like down to like 20, 30 cents. And that, after they got acquired, it was about $4 at its peak. But it's obviously come down. And I'm sure it's going to come way down. That has a lot of activity too, but not as much as Camber. We can't really see, but that's a $500 million line. So I mean, it's crazy how much activity. So, is anybody in this Camber stock? They're saying they want to do a short squeeze because the company was pretty close to bankruptcy. But then they acquired, I don't know how they acquired Viking. Viking is so much more revenue, but they have a smaller market cap. And it looks like the stock wasn't too shorted. Net revenue negative. No, or as of last year. It's not negative. It's a few $100,000 their revenue. When you say net revenue, net revenue is revenue minus what you don't expect to receive from your accounts receivable. Is that what you mean? Did you mean that? Because it's very rare for revenue to be negative. And they don't really have much in receivables. So, but it looks pretty bad. I mean, look at their revenue, 6 million, almost 7 million, about 3 million, down to 400,000. But nobody was really shorting the stock until I guess it was too low to short, because if you look at the short interest, you can't see it here. I just know what it is. You mean net debt? Net revenue. No, they don't have any debt. Camber doesn't have any debt. They just raise capital. I'll show you in the statement of cash flows how you can kind of identify. So this is it, their statement of cash flows. So they don't have any CapEx. So since they don't have any CapEx, well, let me see if I could blow up the investing section. Again, they don't have the info in Yahoo Finance, but because CapEx goes into investing cash flow, right? So they don't have any CapEx, but they have negative 13 million of investing cash flow. So that's when you acquire a company, it goes into investing cash flow in a cash flow statement. So the acquisition for Viking is inside here. It's not too clear on Yahoo Finance when you open it up, but it's in this section. And they raised $11 million of stock to fund that acquisition up here. And they don't really issue debt. So it looks like in 2020, that might be part of that number. But yeah, but they issue stock. That's just how you can figure that out, in case anybody was curious. But do you guys? I mean, I don't think I can buy this stock, but I definitely think it's going to go up. But the problem is, if you buy it, say you buy it at $3, and then it goes to $9. And then you hold out. You're like, you're thinking of selling it, but then you hold out. And then it goes to $7. The problem is you're not going to sell it at $7 because it was $9. So you don't want to, and then and then if it goes to 6, you're still not going to sell it because it was 9 and 7. But that's a problem. People have a hard time letting go. Not really. I don't do options. I have, but not too much. But that would be good for something like this, is to buy options. Because if it does go up a lot, you can make a lot of money. But the premium, the option premium is kind of built in because it's kind of a known thing about this company. Like if you bought options down here, you could have made a ton of money. Like you could have paid very little for the options. But even right here, like the premium is so high because it's all built in, because there's so much volatility at this point. Like I don't know, it would be almost impossible to identify these things before they happen, but if you could, like there was this guy who bought GameStop options, and he was confident GameStop would go up, and he was right, and he made like, I think it was like 20 million from it, and I think he only put a $250,000 into it. He has a YouTube channel. But if a stock gets really volatile like this, I mean, you could make money with options, but you're not going to make that much more than just buying the stock, because it's kind of built into the price. Bore drilling. What's up, Vasil? So bore drilling. Is this another short squeeze? Well, look at that beta, 4.18. Oh, 50K? I was thinking that. And then I was like, that sounds too low. He put 50K in options and he was up to 70 million. See, because he identified it before everybody knew about it. It's not that the price of the stock, I mean, of course, if the price of stock goes up, you're not going to benefit as much. Roaring Kitty. Yep, exactly. Roaring Kitty. He's he's a financial advisor. Like he has a lot of knowledge already. But he convinced me that GameStop is a good buy. I watched his video and it makes sense. Yeah, this is. Oh, this is not shorted. So what did you want to talk about? Bore drilling? Anything in particular? Yeah, he's set for life. Roaring Kitty. He doesn't have to work for the rest of his life. That was just amazing pick. But anybody else want to talk about Camber? It's just such a shady company. They acquired Viking Energy. And Viking has, here's Viking. They have decent numbers. I mean, 40 million of revenue, up from 8 million. I mean, they're losing a lot of money. $83 million loss, $62 million loss. They do have positive operating cash flow, so that's impressive. But if you look at the equity section of these companies, I'll pull up the equity section. I talked about this in the video a little more in depth, the equity section. So this is Camber's equity. They have 4 million of equity, and they raised 147 million from issuing stock, and they lost 162 million from running the business. So when you see this negative greater than this additional paid in capital, that's a big problem. That's like, how can I give you an example? I guess that's like if you had a business and you sold the entire business to investors for, say, $100,000, and then so that's how much cash you received from selling the business, and then you lost $100,000 the next year from running your business. So all the money you got from your investors, you lost. So you have no money left. They're down $15 million. They're short $15 million. So they don't have any money to run a business. So the only way they can survive is to raise capital. And that's what's going to happen. That's the only thing that's beneficial from a stock squeeze for the company. When the stock gets artificially pushed up, like it is, I mean, it was, this is Camber's. It was well under $1. It was like 35 cents, I think, the low. Now it's at the $3. Now could issue stock at the $3 rate. Because when the stock price is down here, it has to issue stock at this price. So let's just say it was a $1 share back here, and they issued they wanted $1 million. So they would have to sell 1 million shares of stock. But say the price, say it got up to $10 from the short squeeze. And if they needed $1 million, they don't have to issue 1 million shares, issue 100,000 shares because the stock price is higher. What do you mean no? Are you talking to me? Just from how I understand things, and let me know if there's any other thing that's beneficial, but when a stock gets artificially pushed up, like AMC, GME, the only two things that it benefits the company is they can issue, well, the main thing is they can issue stock at a higher stock price, so they have to issue less shares, and or the convertible debt gets converted to debt. I mean, all the convertible debt gets converted to equity. So it removes a lot of debt from their balance sheet. So those are usually the two big benefits, or the only two benefits from a short squeeze for the company. But yeah, I mean, I won't buy it because it's against my principles, but yeah, I think it'll go up. I think it's going to go up to like 10, probably like $10. But the thing is, if you don't sell it, and then if it goes down to like 8, you don't sell at 10, you're never going to sell at 8, and then it's going to end up going back down to 1, and you're going to lose all your money. I don't know about Elon Musk or the White House. Does anybody know about that? I could see Elon Musk maybe, but not the White House. Well, they do have they do have a device where they can make internal combustion engines cleaner and more efficient. And that's when the stock went up to that's part of the reason it went up a lot too, I think, is because they had a deal with a company to license out that product for the internal ICEs, small U.S. oil and gas company whose main subsidiary seems to be in dire straits financially. So its main subsidiary, Viking has negative equity. However, the company's valuation has soared following the announcement of exclusive IP license. Yeah, they licensed that product out. I don't think there's any indication the technology is revolutionary, that it could bring significant revenues or profits to Camber. There could be significant retail investor interest. This one looks like a sell and a short borrow standard. Thought it might be related to yeah, I don't know. Actually, I don't know their financial position because they haven't reported financials since September of last year. They skipped 12/31, 3/31, and 6/30. They just didn't report anything, which is a big red flag. So I don't know their cash position. I'm just looking at their as of 9/30/2020. But yeah, if they did a capital raise recently, then they probably wouldn't need to raise more capital. You see the SEC filings, they the last time they reported was 12/21/20. They said they have an inability to timely file their financials, so they haven't reported anything. They acquired another company. So they raised $15 million from an investor. As long as they can keep raising money, they won't go out of business. That's why a lot of these companies go public, so they can keep raising capital. Because when you're private, it's just harder to raise money. This is when the short interest got really high starting in August. It was pretty low for a while, the short interest. You see, the short interest in September 2020 was only $1 million, less than $1 million. So it was around 1.5 million for a few months. Then it went to 2.5, then it went to 24 million. And that's, I wonder what it is as of 9/30. It's probably like 40 million. So as of 9/15, that's when people started shorting the stock. As of 9/15. So this is when people started shorting it. So you couldn't really short it down here, even though the company looked like it was either go bankrupt or getting close to it. You can't really short a stock. Well, you could, but you're not going to make any money if it's under 50 cents. It's hard to make money. You have to wait for it to come up a little bit. So they started shorting it right here. It's probably even higher, the short interest. What do you mean I'm using pump and dump on retail investors? I'm not suggesting to buy it. I'm just talking about it. I just did a video on it. Here's their so they put together a presentation in May, which is more updated than their financials. And they talk about they own 62% of Viking in May, but that's gone up. I think it's 100% now. And Viking had 40 million of revenue in 2020, and they just list the assets they have. So it seems like they have more of a business going on than Camber. They have 145 producing oil and gas wells, 30 drilling prospects. All the stocks you discussed here tend to go up in price just a month ago or two. I don't know what you mean. So when I discuss a stock, it's gone up last month, tend to go up. So if a stock goes up in the past, I talk about it. How do I do that? I'm not sure what you mean. But yeah, I showed in my video. Let me show you what I did in my video. Let me get the equity section. I put the equity section of Camber next to Viking, next to another company, just to show you how to identify a good equity section. So this is Viking. Boeing. Oh shit. He picks deep value companies. So this is Camber. Viking. I hope you didn't hear me when I said the name of this company, because the whole point is so you don't know who this is, and I could. So this is the equity section of these balance sheets. So for Camber, And this is as of September 30th, 2020, because that's their most recent financials. That's all I have. It might be different now, but as of that point, they were in bad shape because they raised $147 million from issuing stock, and they lost $162 million. So they lost $15 million more than they raised. And they don't have any debt either. So I'm not sure how that's possible, actually, if they have no debt. But that's bad. If retained earnings, the negative is larger than a positive and additional paid-in capital, that's really bad. Wait, let me. This is the wrong Viking. Okay, this is the right Viking. So the equity section of Viking's balance sheet, the equity section may be able to give you a lot of information to figure out if the company is on the verge of bankruptcy or not, or they're a healthy company. Because retained earnings, like if you look on the income statement, you can see net income, but just for that year, or maybe last year too. But if you look at retained earnings, it's all the net incomes summed up since you started as a business. So it gives you an idea of how strong or like how successful or how much the company's struggling. So Vikings even, well, not worse, they're pretty similar. Viking raised $96 million. I don't know if you guys were here for the analogy earlier, but say you had a business and you needed to raise money. So you sold the entire business to an investor. You could say it was a friend, but you were going to continue running the business. They bought the whole business from you, so you can get capital to kind of grow the business. And you sold your entire business to your friend for $96 million. He gave you a check for $96 million and said, "I'll buy the business outright, and then you're my employee." And what do you do with your business when you get $96 million? You lose $111 million. So pretty much everything that was given to you, you lost and more. So that's not a good sign. If this was a startup, like their first, second year, or even third, fourth, fifth year, it's okay. It takes time, but I don't think these are startups. So this is another equity section. I hope you didn't hear when I said the name, because that's the whole point. So you don't know who this is. This is another company, and you see negative 17 billion of equity. So you might think this is a terrible company. It's a buy according to the model. So if you were to look at these three equity sections, you might think this company is the worst, right? Because negative $17 billion, that's a big negative. So you would think, okay, Camber's in the best shape. But the reason they're negative, you have to kind of look also beneath the numbers. Like you could, it's possible a company can not be in terrible shape with these numbers. but I don't think that's the case with them. So the reason they have negative 17 billion of equity, which seems bad, is because this company. Does anybody know who this company is? I'll tell you in a little bit, but they bought back $52 billion of stock, treasury stock. So what happens when you buy back stock? You have to use cash, right? So your cash goes down $52 billion. So your equity goes down $52 billion. So they didn't have to buy back the stock, right? If they didn't, they would have plus 36 billion of equity. But they bought it back. So they could just reissue the stock into the open market whenever they want. Hopefully they can issue it at a higher price than they bought it for. That's a different story, but this is, and they have 38 billion of retained earnings. So historically, this company has profited $38 billion. So they're by far the superior company when you look at the equity sections. I mean, there might be more information to look at, which is possible, but just from looking at the equity sections, they're a much better company. Just because they have negative equity doesn't mean they're a bad company. Does this make sense? Does anybody have any question? Are you following this? Does anybody know who this company is? I did say it while I was pulling up the chart by accident, while I was looking for the. Does anybody know who this is? I use them a lot to I'll give you a hint. They're very involved with aircraft. That's really their business. Something with airplanes. Any guesses? Or Boeing? Yeah, good guess. Yeah, Boeing. So that's just Boeing's. They just buy back a lot of stock. Airbus, another good one, but yeah, it's Boeing. Starbucks is similar too. Let me show you Starbucks. That's the good thing about investing in these huge companies. Yeah, the government will let them go bankrupt. See, Starbucks also has negative equity, but they have negative retained earnings. So this is a little confusing because I just said like this company's really strong because they profited $39 billion. But they actually are profitable, Starbucks. For some reason, I just don't know why, but some companies don't have treasury stock. Like it would be so much easier if they had treasury stock so we can see how much they bought back and we can see how much they profited. But instead of putting treasury stock on their balance sheet, they just reduce retained earnings, the amount they bought back. So they might have bought back $20 billion of stock. So they should have 12 billion of retained earnings. I'm just making up a number. but instead they have negative 7.5 billion. Because it's the same idea, if you, reducing retained earnings or adding treasury stock. Book value? Well, this is book value. Equity is book value, right? Assets minus liabilities. No, I do agree with him and you. I mean, yeah, some companies it's irrelevant. Other companies it's more relevant. But I think it's good to know. Like if a company has a ton of intangible assets, then it's kind of like then their book value may be really inflated. Or there's other things there too, but that's the main one, I guess. If a company has a lot of goodwill on their balance sheet, it really raises your equity. Or in this case, they bought back so much stock, their book value is negative. So it's really hard to tell. Like these are really solid companies, Boeing and Starbucks. They're not going anywhere. I mean, Boeing is having a little trouble, but I don't think they're gonna some of their planes. But yeah, so it's a little deceiving looking at this. You don't get much information. You'd have to know they bought back stock. Like if they didn't buy back, like if Starbucks never bought back any stock, this would look terrible. This is like a company that's definitely going to go bankrupt or should have went bankrupt, but they bought back so much stock, which is like an asset, right? They can just reissue that stock into the open market. It's sitting on their balance sheet, but it's dragging down the value of the company. A couple of new planes. But any other tickers? Any ideas? These live streams are hard to. They use debt, so it's negative. Well, they definitely use debt. But right, the liabilities are 6 billion more than their assets. But what's even in Starbucks' case, and other companies too, but in Starbucks, they have so much in liabilities that are unearned revenue. If anybody knows what that is, unearned revenue. So if you buy a gift card from Starbucks for $100, but you haven't used the gift card yet, like it's on your phone or in your wallet, that goes onto their balance sheet as unearned revenue, as a liability. So they have so many billions of dollars of gift cards that aren't used yet, but people paid for them in advance. So they can't book it as an asset. They have to book it as a liability. And then once they use the gift card, it's taken off the liability section and put onto your asset section. And the cash gets booked. Well, it's a timing thing. I'm not saying, I'm sure some people don't use the gift card, but it's more of a timing thing. They're always going to have billions of dollars of active unused gift cards at any point in time, because they have so many gift cards, people buying and things like that. So they just have to book so many liabilities I talked about this in a video on Starbucks. When you look at the equity and you say, "Oh my God, it's negative equity. It's a terrible company," or but once I showed like how much stock they bought back and how much unearned revenue they had, they're actually a very strong company. So just looking at this, or just looking at one number, you can't really get that information from. Yeah, CEI, I think it could hit 10. But the thing is, it's just really hard because like when AMC like hit like a whatever it was, 10 or 20 or 30, I guess you would have been pissed if you sold it early. But the thing is, sometimes you hold on and then it keeps coming down and you end up losing money. So yeah, I think 10 would be a good time to sell. Yeah, I could see it going way high. Yeah, because so many people buying it, so it's just crazy. And with Elon Musk backing them, I should do some options. Although it's probably not going to make a difference between options at this point and just buying the stock outright. I'm pretty bullish on the oil industry. I think it's just. Are you saying that because of the EV market? Or are you saying that because of like a possible recession? If there's a recession, then yeah, nobody can predict that, and the economy may collapse for a year or so or two. But if you talk about EVs, I don't think EVs will affect oil at all. Maybe in like 100 years, but right now there's still too much reliance on oil. So I don't think both are going up a lot. Like the oil usage and EV usage are both increasing. It's not like EVs are replacing oil. They're both increasing at a good rate. Structural underinvestment and the overconfidence, in my opinion, in EV. The thing is, people don't realize how much money was spent to build the infrastructure for the oil industry. Like it's an unbelievable amount of money was put into it. So there's too many people whose jobs, and it's just hard to just switch everything over, unless you were starting from scratch, like a brand new city or a brand new country with nothing there, and you're starting from scratch. Then yeah, you can do everything EV. But right now, it's just it's too much to change. But it's slowly changing. But we're still not going to phase out. People are still buying ICE cars like before. But okay, a lot of countries, developing countries, are going to use ICE cars still. They're not going to use EVs. They can't afford EVs or afford to have the charging stations for EVs. Like in the US or in Germany or the UK, you can have charging stations every half mile, because people need charging stations every half mile, or they can't go on long trips. You can't have that in developing countries. If like 8 people have an EV, if 8 people in your entire city can afford EVs, you can't have a charging station every every mile or so for those 8 people. Okay, I'm gonna get going. I'm gonna probably do a live stream on Thursday with a crypto mining company, the CEO of a crypto mining company. That should be fun. I'm gonna go through my Excel model with the actual CEO of the company, and he can kind of talk more about things. Okay, thanks for joining, and see you guys later.